Hello, everyone. Welcome to today's Practitioners Insight webinar on investing opportunities in India, a global perspective, hosted by CFA Institute. First and foremost, a very warm welcome to our audience from around the world joining us today for this engaging and interesting webinar. I am Pankaj Sharma from CFA Institute, and I will be the moderator for this session. I lead capital market policy for CFA Institute in India, and in my role, I'm responsible for advocating policy positions on issues that affect Indian capital markets and its stakeholders across a broad range of subjects. Before I introduce our speaker for today, I have a couple of housekeeping notes. First, today's webinar is scheduled for about 60 minutes. First 40 to 45 minutes will be presentation by our speaker, and then 15-20 minutes for Q&A. But be assured that we will be leaving ample time for question and answer session. I'm sure that you will have a lot of questions to ask to our speaker, and do send us these questions in the Q&A tab. We immensely value your feedback, so please complete the evaluation survey before you sign off today. And now it's my pleasure to introduce our speaker for today, Mr. Rajeev Agrawal. Rajeev is the fund manager and managing partner at DoorDarshi India Fund, and this fund is based out of the United States and enables investors to benefit from opportunities in Indian equities. Rajeev has been investing in the US and Indian equity markets for more than 15 years. He follows value investing principles and finds that the Indian equity market provides wonderful opportunities for his role and style of investing. Before starting the fund, he was a technology executive focusing on the financial industry, and he has worked with IHS Markit, Goldman Sachs, Bank of America, JP Morgan, and National Bank. In fact, there are not many opportunities left outside this space. He has worked with almost everyone. Rajeev earned his bachelor's degree in technology from IIT Bombay and his MBA from IIM Calcutta. A very warm welcome, Rajeev, and it's a pleasure to have you with us here today. And I'm sure that our audience is eagerly looking forward and will have a great experience listening to you. So without further ado, over to you.
Thank you, Pankaj. It is a pleasure to be presenting to the CFA Society India event and having so many eager participants. So before I start my presentation, I want to put out a few quick disclaimers for the audience. The information that I'm presenting today is only for learning purposes. It should not be reproduced or used without the written consent of DoorDarshi advisors. The presentation that we have contains forward-looking statements, and I would encourage the participants not to put too much reliance on these forward-looking statements. We do talk about some stocks, and again, for those stocks, we may have a bias. So we would encourage participants to do their own work and not rely on what we are saying. And lastly, we are not looking to sell anything to the participants today. This is for informational purposes. So there is no offer to sell or any expectation for you to buy anything. And any such selling will only be done through proper documentation. So with that disclaimer out of the way, what we will do is get started with an audience poll. To better understand the audience, we are asking you to tell us how long is your experience with the equity markets? Are you a beginner? Are you an intermediate? Or are you an expert? And that could be by knowledge that you have, or it could be the number of years you have spent in the stock market. We'll give it a few more seconds for people to participate in the survey, and then I will give you the feedback on what type of audience we have. Okay, I think so. We have around 55% is beginner, 24% is intermediate, and 20% is expert. I think that gives us a very good flavor of the type of audience we have. And as I expected, this is what we would have expected from this audience, which will be a mixture of beginner, intermediate, and expert. And that's great. So moving on, let's look at what we are intending to cover in today's presentation. So Pankaj gave some background about myself. I will elaborate a little bit so that the audience has better understanding of my background as well as the fund's background. We will then take a global perspective, global macro perspective on how the equity markets are looking in around the world. We will then talk about the case for Indian equities and why is it that we like Indian equities. We will then subsequently jump into the investment philosophy that the fund has, DoorDarshi India Fund has, and what we do with that. And we will illustrate our investment philosophy through a few case studies. Also, we are looking to build a team in India. So I will talk about the type of people we are looking to hire in our team in India, and then ultimately we'll go to your questions. So a little bit about myself, as Pankaj covered, I have been investing in Indian equity markets for more than 15 years now. I became a full-time investor in 2016 after being in the corporate world for almost 2 decades. I launched Doordashi India Fund in 2021, and I'm also a top-ranked analyst on SumZero, where I'm ranked #1 worldwide for financials and also ranked #1 worldwide for special situations. Before starting the investment journey full-time, I was in the corporate world for almost 2 decades. And as Pankaj said, I retired from IHS Markit, which is subsequently being acquired by S&P Global as a managing director, and worked with Goldman Sachs, JP Morgan, and Bank of America on Wall Street. And then education-wise, I'm a CFA charter holder with BTech from IIT Bombay and MBA from IIM Calcutta. A little bit about the fund. So the fund was started in April of 2021. It is a US domiciled hedge fund registered as a foreign portfolio investor into India, and it invests in listed Indian equities. The approach that we take with our fund is to have a long-term orientation. We are very particular of the investors that we allow into our fund, because we want to ensure that our investors can have the similar orientation as what we have in the fund. We are both sector and market cap agnostic, so we will go into areas which we feel we understand and where we are finding good opportunities. We try not to put too many artificial constraints around for example, diversification or sector limits. If we find a particular sector is giving us the best opportunity, we are likely to concentrate in that particular sector, for example. And even in stocks, when we find compelling opportunities, we are very happy to concentrate on those compelling opportunities. So here is the returns. And again, the purpose of returns is to tell you how we have done. This is, as I said, this has nothing to do with any selling. But the one thing which I think is very important when you're looking at an approach is to see whether that approach is working for you. So I'm showing here the returns since the inception of the fund in April of 2021 till the end of 2024. In that period, we have delivered a 27.9% CAGR dollar returns as compared to S&P 500, which has done 12.7%. Nifty has done around 10%, and MSCI India has done around 11%. So a few things I will like to highlight. One, obviously, we have done far better than any of these indices, which is great. The other thing is these are past returns, and so they're not a good predictor of what will happen in the future. The fund returns has been audited by Spicer Jeffries, our auditor, from 2021 to 2023, and 2024 returns are still being audited. So these returns are from our fund administrator. All the returns are in US dollars, and they reflect the returns of all the limited partners in the fund after fees and expenses. So they have been taken out. The fees and expenses have been taken out from these returns that I'm showing here, but before taxes that we pay in India. And then for the indices, S&P 500, Nifty 50, and MSCI India, these are in dollar terms and include the dividends. So these are total returns of these indices. Now, a 27.9% annual compounding gives us a total return of 152% for the fund, since its inception till end of 2024, versus 57% for S&P 500, 44% for Nifty 50, and 49% for MSCI India. Looking at these results in a slightly different manner, pictorially, $100 invested in the fund has become around $250 at the end of 2024, versus between $140 to $160 for the other three indices. So clearly, we have done far better than these indices. And hopefully in this presentation, I will tell you how we have approached investing, which has allowed us to deliver these good returns. But before that, let's get into and take a global macro perspective. So if you look at the MSCI World Index, which is made up of 23 developed economies, you will see that US weight in this index is around 73%. So it's dominating that particular index. If you were to look at MSCI All Cap Weighted Index, again, you will notice that first of all, this has 24 emerging markets and 23 developed markets. And yet, US stocks have a weightage of 66%. So I think it's fair to say that given the dominance of US equities in both the All Cap Weighted Index and the World Index, you can say the US is really the only game in town, and everybody else is just a fringe player. Given that, let's focus on the US markets a little bit, because when we focus on the US markets, we are really covering the global indices quite well, given the weightage. So if we look at S&P 500, and wherever I'm presenting the slides, I'm also talking about the source. So you have a way to go and check on some of this information if you want to. So S&P 500, if you look at it, the price to earnings as of end of January 2025 is around 21.9 times. And that price to earnings is much higher than the average, which is around 16.9 times. So in fact, it is 1.5 standard deviation away from the average. So one can say that the markets, if you look at it historically, seem to be on the expensive side, the S&P 500. There are many other stats that I have here on the chart, but the last one I will point out, which is earnings yield spread. And this is the earnings yield of S&P 500 minus the triple B bond yield. And that is negative currently versus what it has been positive in the past. So I think it's fair to say the markets look expensive, but that is based on what has happened historically. Given these price to earning, what has been the expected 1 year return? It is very low single digit, close to zero. So one should reduce expectations if you're looking for good returns, given this valuation in S&P 500. And again, you see this is the work that JP Morgan Asset Management has done around it. Similarly, if you look at the 5-year annualized return, you will also notice that the return expectations given this price to earnings is relatively low. So I would say one has to be cautious, one has to lower the expectations given where the market is trading. The other point to make is that if you look at the US dollar index, the US dollar index has been hitting relative new highs in the more recent past. And this is happening despite the fact that the US federal deficit is the highest it has been for a long time apart from recessions. During recessions, the federal deficit goes up, which is understandable. But during normal times, and we are living in normal times, we don't have recession. And yet the US federal deficit is hitting new highs. And it is around 6%. If, as is expected, there is the passing of the Tax Cut and Jobs Act, then one would expect this federal deficit to even go higher to 7%. So on one hand, you're seeing US dollar index hitting new highs. On the other side, you're seeing that the fiscal situation is not as good as reflected by the federal deficit. Similarly, if we were to look at the US debt to GDP, it is once again among the highest it has been outside of the war, which was the World War II. And right now, what is projected is, given the trajectory, US deficits will keep increasing, and therefore the debt will keep increasing. So there is a little bit of a contrast about how US dollar is behaving versus what the fiscal situation is for US economy. So with that background, let's talk a little bit about the case for Indian equities. First, Indian economy has grown very well. So between calendar year 2013 to 23, Indian economy grew at 5.7% real terms. And that was the second fastest among large economies. China grew faster than India. But going forward, in the next 5 years, India's economy is expected to grow at 6.3%. And that will be the fastest growth rate of all the economies that I'm mentioning here. With that growth, India is likely to be the third largest GDP by the end of this decade, overtaking both Germany and Japan. So that's one, which is GDP will grow. And as GDP grows, there will be more opportunities in terms of equity investments, and hopefully that will allow us to do better than what we will do in other places. The second reason is the demographics. If we look at India's population, there will be net addition of 179 million people who will be in the working age, which is from 25 to 64 by 2045. Now, if you contrast that to what you are seeing for the rest of the economies or the rest of the countries, you will see that US, Brazil are pretty close to break even. And then you see, on the other hand, China, where there's a significant reduction in the working age population. Now, working age population impacts in many ways an economy, right? One is working age population is obviously a factor of production. And if you have more factor of production, the economy will grow well. But the working age population also provides demand. And so both demand and supply is increasing, which will help the economy grow. And therefore, it is a strong tailwind for Indian equities. The third thing to look at is leverage. And if you look at the debt to GDP of India, it is among the lowest as compared to many other economies that we have here on the chart. And the interesting thing is not only it is the lowest, but in the last 23 years, it has not grown as much as in many other economies. And so the leverage overall looks pretty good. If I look at the leverage from a company perspective, which is a corporate debt to equity, you will notice that the debt to equity is the lowest it has been in 15 years. And what that is telling you is that corporates are in good shape. They're able to take advantage of the opportunities that will show up to them, and they will be able to use their balance sheet to grow into those opportunities. The other one, so the three factors obviously are the government, the corporates, and the household. And what I am trying to show you here is from an overall perspective and the three different players, all of them are in good shape. If you look at the household debt to GDP, it once again is very reasonable, around 35%, versus many other economies that are at much higher leverage. And that again is a driver because the household can leverage themselves more if they want to, which will again be a help in terms of the growth of the economy. The fourth factor is formalization. As many of us would know, India has a huge informal sector. And what is interesting is that over the last, let's say 10, 12 years, you can see how many more tax filers have come into the system. So it used to be 31 million in financial year 2012. Now it is 80 million, more than a double, right? And that is great because you have more income being reported, more taxes being collected, and government able to use those taxes in a more productive manner. This is another driver for India's GDP growth, but also in terms of the opportunities. Now let's come more towards companies and how they are doing. If we look at the return on equity of Indian companies, you can see that it hit a bottom around COVID. And once again, it has started trending up. Right now, it is around the 15% mark, which is very, very good, I would say, and you will see that in the subsequent slide. But we are seeing return on equity go up. Why is return on equity important? Because it allows companies to grow without diluting their shareholders. And therefore, if you don't dilute your shareholders, whatever the growth of the company is in terms of earnings comes to the shareholders. And therefore, the shares should ultimately reflect the earnings. And so that gives you a good opportunity to do well. If you look at the return on equity versus other countries other than US, right now, US is the best in terms of return on equity, and then the next one is India. And then the sixth factor is the allocation to equities. if you look at what percentage of the household asset has been deployed into equities, you can see from 2013, when it was 2.2%, it has grown to 5.8%. And so there is a significant movement into equities by the households. But what is even more important is where India is today in terms of the household assets to equities, which is 5.8% versus the US, which is around 40%. So there is still a long runway for Indian households to keep putting more and more capital into equities. And that will be a big tailwind for Indian equities as we go ahead. Let's look at the historical returns, how Indian equities have done. So obviously, I've talked about here are all the good reasons why one should look at Indian equities. But how have they done? And so here's a chart which shows over 5, 10, 15, and 20 years how Indian indices have done versus the other country indices. And you will notice that in all those 4 periods that I've shown here, BSE 500 has had double-digit dollar returns, right? So first thing to note is that there are very few countries who have delivered that type of returns. Obviously, India, Taiwan, you will see here, and S&P 500. Those are the 3 main constituents here which have delivered double-digit returns. And I think, given the fact that I've laid out in the last few slides, we think that these type of returns are very possible even going ahead because of the inherent momentum of the economy. And so we think India is well placed historically, but also in terms of what is looking in the future. Now, one of the questions I always get is, well, this is good, great, but what about the valuations? How isn't Indian markets very expensive? So here I'm giving you a few charts on the valuations of different indices. So here we are looking at Nifty 1 year forward price to earnings ratio as of February 2025. Clearly, Indian markets have corrected, and that is a good thing for an investor because now the valuations, if you look at for Nifty, it has come down to below average. And so when we looked at S&P 500, we saw that the valuations were way above average, but for Nifty 50, we are saying that the valuations now are below average or around average. So they are not a headwind. Similarly, if I look at Nifty mid cap, again, the trailing 12 months price to earnings ratio is around the average, and that is a good news. And lastly, small cap, Nifty small cap 250 is once again below average from a trailing 12 months perspective. So from a valuation perspective, I think it is reasonable to say that Nifty 50 is now trading, as I said, at 19.5 times, which is around 7% below its long-term average. Nifty mid cap is at around 30 times, so it is definitely at a premium to Nifty 50, but it is below its medium-term average, not long-term average. And Nifty small cap is around 22 times, which is a 13% premium to Nifty 50, but again, at below the average in the medium term. So that's the valuation bit, which I think is no more a headwind. It used to be a headwind in the past because the valuations went up a lot and it has come down some. So what are the risks? The one big risk is the supply of new offerings that has come in the market. So if we look at the new offerings as a percentage of the free float, in 2024, we had almost 3.3% of the free float come in as new offerings. Now that has happened in the past, as you can see in 2020, 2017, and 2010, where it was a similar number or higher. And we know that when such high amount of offering comes, then a lot of liquidity is taken out from the secondary market, goes into the primary market. And that is what we are seeing here, where in 2024, we had almost 6.1 trillion rupees of new equity offerings that came in. 4.3 trillion was bought by mutual funds, and 1.2 trillion rupees was bought by FIIs. But where did FIIs get that money from? They took it out from the secondary market. So the problem, or one of the challenges, is that there is a lot of offering, and therefore not too much money is going into the secondary market. Not as much money is going into the secondary market. The second risk is the weak earnings. And we have seen in financial year 25, if you look at BSE 500, we know that the earnings growth in Q1 and Q2 were negative, and Q3 has been tepid as well. So far, financial year 25 earnings have been quite weak. And you can compare that to financial year 24 earnings, which were stellar. Same is the case with Nifty 50, where the earnings were weak. In Q1 and Q2, they were negative actually, and in Q3 has been quite weak, but they were quite good in 2024, financial year 2024. However, MK is projecting that 2026 earnings will be much better at 13.5%. Remains to be seen if that happens, but that is one of the risks if earnings do not come through. So I gave you a quick rundown of the global macro, talked a little bit about the Indian macro, both in terms of economy, but also in terms of the stock market. Now what I want to do is to talk about Doordashi India Fund and the investment philosophy that we follow at the fund. So there are a few investment tenets that we hold dear to our heart, and that is how we invest. And the first one is the expected return framework. And what that means is that whenever we look at investing in any opportunity, we try to figure out what is our expected return in that opportunity. How do we figure that out? We look at what is our expectation of how the company will perform in the next few years. Therefore, what should be the price in the next few years? Look at what is the price today, add any dividends, divide by the current price, and that is your total return. And then, of course, you can annualize that based on how far are you looking out. But effectively, what this does is it allows us to convert the massive differentials that we have across companies into a uniform way of comparison, which is the expected return. And this expected return forms the basis of investing in any opportunity that we see. We think that management is a key factor that will allow us to succeed in any investment, especially in the context of India, where management cannot be changed easily by the investors. It is important to partner with management who are working with you, who are well aligned with you. And so we do think that in India, if you cannot get comfortable with management, it is very hard to succeed. And therefore, we believe in this dictum, which is can't do a good deal with a bad management. So we always look for good management. In order to be able to value a business, we need to understand that business. This is where the circle of competence comes in. You should be able to understand why that particular business will do well. You should be able to understand what are the issues that will prevent you from doing well. And so that is all where circle of competence comes in. And we only want to invest in what we understand. Every day, a new business will come in, new opportunity will come in. But if we don't understand it, it's not even an opportunity for us. And that's something we, again, follow from a discipline perspective. I did talk about the long-term orientation early on. And this is, again, another area that allows us to differentiate ourselves vis-a-vis the markets. Typically, equity markets are looking maybe a few quarters out, but not necessarily beyond that, mostly the next quarter. When we are looking at least a few years out. So the opportunities that we are looking at versus the opportunities that the market is looking at are very, very different. And this allows us then to look for opportunities that the market will ignore. And if the market is ignoring opportunities, those are the opportunities which will have good valuations, good pricing, and we can benefit from them. And it is equally important to know what not to do as it is to know what to do. So we actually ignore a lot of the perceived investment wisdom that is out there. And some of those are that volatility is risk. We don't agree with that. We think volatility actually creates more opportunities for us. And to the extent that if we have bought a stock at, let's say, 100 rupees, and we think it will go to 150 in 3 years or 5 years, and now it has fallen to 75, right? If nothing else has changed, it has become a better opportunity for us. So we think volatility allows us to have more opportunities, and we want to participate in that and not worry about volatility. Similarly, diversification. It is said that diversification is the only free lunch in the market. I think diversification is great for people who don't know investing or who do not have the time to practice investing. But for fund managers like ourselves, diversification for its own sake makes no sense. We should diversify when we don't see too many compelling opportunities. But when we find compelling opportunities, we tend to concentrate. The third one is trying to hug the benchmark too much. I showed our returns across versus S&P 500, MSCI India, and Nifty 50. And you would have noticed that while overall our returns are great, in different years, we would have done quite differently versus the benchmarks. And so what we are trying to say is we will focus on our investment process and our investment opportunities. And if we do that, over time, we will be able to beat the benchmarks. We don't look at what benchmarks are made up of, and we definitely are not trying to replicate that. And lastly, and this is a funny thing, that wherever I go to many of these conferences, people say, oh, so what is your AUM? What is very interesting is AUM tells you nothing about how well a person is doing in terms of their investments, in terms of the returns, in terms of the investment process. And yet, everybody in the industry wants to know your AUM. We try not to even talk about our AUM. And the reason is we think AUM is leading people to the wrong path of focusing on collecting AUM. We would rather collect good investors, investors who understand our process so that they can stay with us for the long term. And AUM is going to be ultimately a derivative of that, and we don't want to worry about AUM. Frankly, we are very happy with the type of investors, and all we want to do is to continue to have more good investors. So let's talk a little bit about the investment process. And our investment process, really at the center of the investment process, is the ongoing idea investigation. In fact, 90% of my time I spend on idea investigation, and the rest of the things does not take much time. In fact, as many of you know, I'm based in the US. I invest in Indian equities, and I get this question: how do you manage sitting in the US, investing in Indian equities? And it is actually beneficial to me because I'm not watching Indian equity markets. I'm sleeping soundly, and that is quite helpful. So idea investigation is the core of what we do. And whenever we find an idea, and if we like that idea, we think we can understand that idea, it goes on our watch list, and we force rank them based on the expected return framework that I mentioned. Anything which is among the top ranked ideas will go into our portfolio, and that becomes part of the portfolio. And that is where we are managing that idea, understanding it, and either buying or selling that particular idea. And then typically our buying and selling is not that frequent. And so really it's much more that we are spending time on the idea investigation. Sometimes people ask me a little bit more details about how we generate ideas. So here's an example. Typically, idea generation could be either from talking to other people, friends, other investors, going to various conferences. Many times our ideas are really our existing positions. They are the best ideas, and we obviously want to take advantage of them. And sometimes competitors of those existing positions may also be very good ideas. And then, of course, we have to look at newspapers, stock filings, stock screens, and so on to generate ideas. I mentioned about idea ranking, which is to rank all the idea based on our expected return framework. And once we have ranked, we then try to include ideas which are among the top ranks and try to sell ideas which are in the bottom ranks. Now, in position selling, many times people say position selling is an art, and it is definitely an art, but there is an element which I can lay out there of how we sell our positions. We will sell our positions when we are wrong with the idea. And clearly, when you are investing, you're looking into the future. And when you're looking into the future, you don't know what will happen. So you will either be right or wrong over time. And when you're wrong, you should accept it. We sell when the valuations do not justify the current price. We also sell when the business performance has deteriorated, which will impact the valuations and therefore the current, and therefore we cannot keep it. And then lastly, we sell because if we need to raise cash to invest in better ideas or for redemption that we might be having in the fund. Now, one more thing I will talk about is the risk management. And risk management, as I said, risk is not volatility, or volatility is not risk. So what is risk? And what is risk to us is if we do not understand the business well. So it is important and imperative for us to be able to understand the business so that we can value it. We want to look at the past track record of the company and the management to see how they have behaved in the past, because human behavior does not change, and past gives you good clues of how they may behave in the future. We also want to see if the management incentive is aligned with that of the shareholders. The more the incentives are aligned, the more likely it is that both the management and the shareholders are in the same shoes, and either both of them do well or neither of them does well. We typically like to have conservative capital structure, and this helps in withstanding the adversity when it shows up. So suddenly, if the markets are closed, if you have high debt to equity, you have to raise equity at very low prices. Not a good idea, but that is why you want to have strong capital structure. One of the things we do is what is called as pre-mortem. So you buy a stock at 100 today, and you say, well, in 1 year time, it has gone down to 50. What is causing it? And then think about all the negatives that may be there with that particular idea, and what do you think are the probability that those negatives will play out. I think this is the best risk management tool, and that is compelling valuation. So if you can find compelling valuation, the better the valuations are, the less the risk is, and possibly the more the upside is. So this is an example where if you find good companies at good prices, you can minimize risk and maximize returns. And lastly, position sizing. So if you don't have those ideas, then you should not have big positions. Take smaller positions. And as you get comfortable, you can scale up your positions. So that's a quick rundown of our investment approach. Now, let me illustrate our investment approach with a few case studies. So the first one that I'm talking about here is Manappuram Finance. So, and again, both the case studies that I'm presenting are something that I've already presented in the past in public forums. So this is not my selection bias. I'm not being biased. I'm just taking a few case studies that we have done in the past. So the one is Manappuram Finance was presented in May of 2021 on SumZero. It is a non-banking financial company with many lines of lending: gold loans, microfinance lending, vehicle finance, home loans, and MSME lending. When we looked at it at that point, it had strong capital adequacy, and the management had not diluted in almost a decade. In fact, management had created a lot of value for its shareholders in the last 3 decades since going public. It is catering to the unbanked customers, as you can see from the different lending lines. They are obviously catering to customers who are not being catered to by the bank. When we looked at it, it was available at reasonable valuation, price to earnings 8 times, price to book of 2 times. And it had good returns on capital. So let's see how it has played out. So we posted our SumZero posting at 160 rupees in May of 2021. And as of February 16, 2025, it is at 178, which is giving us a total return of 10%. Obviously, I've not included dividends, but if I look at annual returns, that is somewhere between 3 to 5%, including dividends. So pretty bad outcome for us. And again, the price has gone up some in the recent past, in the last few days, but we don't want to worry too much about the recent numbers. So what exactly went wrong? So first is that the company's performance from a business perspective did not do as well. Company lost the gold loan market share to its competitors. And this happened because company was following strict auctioning policy and also higher interest rate. Company doubled down into new lines of businesses like microfinance, vehicle finance, home, and MSME loans, and they haven't yet delivered. As many of you who are investing in financial companies would know, microfinance industry is currently severely hurt and going through a lot of delinquency challenges. RBI also imposed restrictions on its MFI business, Ashirwad, for a period of time, and that has led to a change in the strategy as far as the management is concerned, where companies' risk appetite has dramatically come down, and the focus will be much more on secured lending, which I think is a good thing in the long term for Manappuram. So the second case study is Ujjivan. Now, Ujjivan is a case that we presented on SumZero in December of 2021. And at that point, Ujjivan was going through a reverse merger with its subsidiary, which is Ujjivan Small Finance Bank. And they had already announced that 1 share of Ujjivan Financial will be given 11.5 shares of Ujjivan Bank. So at 132 rupees a share, when we presented the case study, we were effectively buying the bank share for 11.5 rupees a share versus the market price, which was at 19 rupees a share. Looking at the banking business, it had strong capital adequacy and good economics. The management had good pedigree, strong track record, somebody whom we can trust, and so we felt comfortable with that. Again, they are catering to the bottom of the pyramid with a long runway, and the business was available at good valuation. So now I'm talking about the banking business, not at the Ujjivan financial level, but at the banking level. It was trading at 3 to 5 times price to earnings and price to book of around 1.3 times. So what happened? So the Ujjivan financial, which we posted in December of 21, did very well for 22 and 23. We got like a 325% total return. And then in 24, after the merger with the bank hasn't done as much. It is down 41%. Overall, we got a 189% total return in 3 years. And so it has been a happy outcome so far. And once again, the price I'm looking at is as of Feb 16th, 2025, when I presented this slide or prepared this slide. So what has worked? First is cheap valuation. I mentioned in my risk management, good valuations is the best risk management tool. I think this is that particular example. We bought Ujjivan Bank at 11.5 per share, which effectively was buying at less than price to book and less than 3 times normalized price to earnings. It had adequate capital, and so bank was not looking to raise capital in a bad market. The management was focused on doing the right thing, and so our assessment did turn out right. And we know that the business can continue to do well over the long term, as the bottom of the pyramid lending is a huge opportunity. So I have presented 2 case studies, one where we did not succeed as much, or we actually failed, which is Manappuram, and the second one, which is Ujjivan Financial, where we succeeded. And I think the lesson from both these case studies, frankly, is that when you go in, you are trying to do the best job you can, but there will be situations where the business is not performing, where there are external factors like RBI restrictions, which will impact your thesis. And if you can find something at a very compelling valuation like Ujjivan, even if things go bad, like currently what is happening with microfinance sector, which is where Ujjivan is primarily in, even then you will end up doing quite well. So what are the lessons from investing? A few things. We think investing requires both qualitative and quantitative skills. So you need to assess the management, which is qualitative, which is as important as understanding the business analysis and coming up with your own models. So both skills are required, quantitative and qualitative. Luck and short-term events do play a part in what will happen in the short term, but ultimately, if you think over the long term, and that is why I presented both the case studies, which are at least 3-year-old, if you have the long-term discipline, and then that is what ultimately helps you do well. Moving on, you should only invest in businesses which are in your circle of competence. And when you invest in businesses which are not in your circle of competence, what happens is Mr. Market tests you. They will, when the price goes down, typically your conviction is not there. You're not able to take advantage of the price drawdown. At the same time, while you should be in your circle of competence, there is no reason for you, for us, all of us, to not grow our circle of competence by trying out new things, but in a proportion, in a position sizing that will not hurt us massively if things don't work out. And that is how we build our circle of competence. In this business, the willingness to learn and humility are critical traits to succeed, because you have new factors coming in all the time, new businesses coming in all the time, new economic parameters happening. And unless you're willing to learn, what you know is not going to take us too far. And by the way, having this trait, character trait, makes us both a better investor, but even more importantly, a better human being, because you're much more engaged. I feel that investing is something which you are either all in on, and if you're passionate, you can be all in on. But that is great because you can decide to focus in areas which you find most interesting. So you can spend all your time focusing on investing, but really focusing on the areas that interest you. And lastly, through investing, I find I am a better person because I'm much more engaged in what is happening in the world. And I'm always looking for what is happening, why is it happening, and how does that impact what I'm doing. And I wish the same for everyone who choose to pursue this path of investing. Before I finish, I will quickly mention about the team that we are trying to build in India for Doordarshi India Fund, what exactly we are looking for. And so the philosophy that we follow in terms of hiring is to have lean teams. We want to ensure that the people who come in have clear responsibility, they have the long-term orientation, They have an entrepreneurial mindset. Don't expect to be told what to do, but to do it by yourself and really not be paid for results and not for hours. So we want to ensure that the people who are coming in have this sort of mindset. And so the attributes we are looking for are people who are happy, somebody we are happy to work with, humble, open-minded, I talked about, passionate about investing, because if you're not passionate, it takes too much of your time and you will not enjoy it. They should be able to demonstrate creativity and curiosity, should have deep understanding in his or her chosen area, and they should be able to make a long-term commitment. So what are the next steps? You can go to our website where there is a link so that you can apply for positions. The way we will go through the hiring process is we are not looking to know your investment approach. What we want to see is your investment approach demonstrated through the stock ideas that you like now. We don't want to know what you did 3 years back, because then you have the hindsight bias. We want to know today what you like and why. And then we want to see how those ideas evolve as the economy evolves and how your thoughts evolve on those ideas. So that makes it a real-time case study in terms of how you are behaving, how you are interacting with the markets. And that is the hiring process. And we will obviously have multiple rounds of interview as we try to understand your thought process. So what is on offer? We expect to have a lot of flexibility in terms of where you want to work, the hours you want to work, and the areas that you want to work in. We also think that we are somebody who focus on fundamentals and really don't have a lot of the institutional restrictions that many other funds will have. And lastly, we think that working in the fund can give somebody a fast career growth, because at some point we will launch our India-based investment vehicle, and obviously we will look for a co-fund manager there. In terms of the timeline, we hope to finalize our candidates in 2025, but we are going to be open-ended. If we don't find somebody that we like, we will not be rushing into it. But that is what we are looking in terms of the timeline. If you want to apply, you can send an email. But really, if you want to apply, I would say go to our website, fill out the form when you click on the hiring link that we have on our website. And then these are some of the places that you can learn more about. So you can go to our website, DoorDarshiAdvisors.com, or to our YouTube channel and look at what we are doing at DoorDarshi Advisors. If you want to reach out to me, you can send me an email on Twitter or on LinkedIn. So with that, I will stop, Pankaj, and see if there are any questions.
Thank you, Rajeev. It was great. I would say, like, I was so engaged that it will take me a while to start speaking after the presentation got over, because there were so many learnings. And I would say that one thing which probably I liked the most was that you started with an example where your investment thesis didn't go right. Usually people will talk about examples where they have got it right and how their ideas have done well. And it's a sign of what you are preaching, you are practicing that, you are preaching humility, you are talking about the traits which you're looking for in candidate, and that's what you actually did when you pick up that example. But again, thank you so much for telling us about so many interesting things. And I would say that our audience would have also enjoyed this. Now I'll start with questions. I have question. I don't know whether this question is right, but still I would I'll ask this question to you, because the first question we got in the window, Rahul Garg is asking, your fund return till April 2024 were almost same as other 3 indices. What did you guys change after that? And I don't think that table reflected that, but still I will leave it to you, Rajeev, to answer that question.
No, so I don't think that question is correct, in the sense that in 2021 and 2021, we were actually below the indices. So when we started 2021, but in 2022, by the end of 2022, in terms of the total return, we were actually ahead of the indices. And by end of 2023 was a very, very good year for us. So if you look at the returns in 2023, we were far, far ahead after that, because I did not go into the individual year returns. But if you look at 23, we did very well. So I don't think by 2024 we were behind indices. I think that's not the right thing. But what did we do differently, let's say in 22, when we were behind indices? We did not do anything differently. What happens is when you're investing in companies, market has certain expectations. and you have certain expectations. Market's expectations are much more short-term, as I said, and ours is long-term, right? So it takes some time for our thesis to play out. And that is actually, it's a very good demonstration of that, because when we are investing in companies, many of them are beaten up for a reason that they will not do as well in the short term. And that is what market is looking at. We are looking a few years out. And I would say our results actually demonstrate that we were looking a few years out. And as those results started coming in, our fund returns started reflecting it. And so I think what I said is really what played out.
Thanks, Rajeev. And I agree, like the way the table was communicating the performance, this was not the right conclusion that the returns were very different. But anyway, like we'll move on. There is a question from Darshan Kumar Surendra Bhai Patel. And the question is, for demographics, India's fertility rate is now equal to replacement rate, and growth in population will remain stagnant. Average age in India, 29 years. Do you think after 15, 20 years or so, India may feel headwinds and struggle to make more than 5% GDP growth like any other countries have gone through? What will be the implication for capital market? Of course, you are a long-term investor, but 15, 20 years is still much more long-term than anybody would expect, but it's still up to you to reply to this question. Please go ahead.
Yeah, no, I think that's a very fair point that the questioner is making, that over time, as the population growth slows down, then the GDP growth also slows down. We have seen that in many of the developed countries, right? As the population growth has slowed down, then really where the GDP growth will come from is the productivity, right? And productivity can only improve so much. So the questioner is absolutely right that as the population growth slows down, things will slow down for India. But the good news is, as you pointed out, Pankaj, that is at least 20 years away. Because we already know all the babies who have been born, and we know, therefore, when they will become productive age, the 25 to 65. And so we know that we are well in good spot for the next many decades, I would say.
Exactly. I think I would say that still we have some good enough window to not worry about this. And as somebody said, in the long run, all of us are dead. So still we don't have to worry about that. So thank you so much, Rajeev. There is a question which is, again, I usually don't take these kind of questions, but this is a response to someone who has just said that Indian equities is most expensive. And of course, I can tell the name Ashwat Damodaran, but a lot of other people might have expressed the same sentiment that Indian equities are very expensive. And you have handled this thing very, very well, I would say, in your presentation, that why there are so many tailwinds for India. And if we just exclude 1 or 2 quarters where things might not have gone right, but do you have anything to say on valuation, Rajeev? Do you want to comment on that? Up to you.
Yeah, sure. So I think from a valuations perspective, yes, Indian markets are expensive. But I will say a few things. Valuations just in isolation doesn't make sense. What you have to look at is valuations in terms of growth, right? Indian markets, Indian economy, Indian companies' earnings growth will be among the fastest. You have seen, I did not present this, but the nominal dollar terms growth for GDP in India will be 10% plus. If the GDP in dollar terms is growing 10%, which other economy is doing that? And then you look at the companies. If the economy is growing that, hopefully you can find companies that can grow better than that. How many companies can you find in developed, other than, let's say, top 10, which we did not talk too much about, which are growing very well? But there are very few companies that can grow double digits earnings for a long term. Now, when you have high growth, you pay valuations which are higher. You see that if you look at the top 10 companies in the US, they are high growth companies, but their valuations are much more expensive. So you cannot do an apples and oranges comparison, which is, say, US markets are cheaper as compared to Indian markets, but not look at the growth. And I think once you account for growth, then I would say the Indian markets are not that expensive. And the second thing I will say is we are not investing in the markets, we are investing in companies. So what we have to do is, do we think we have enough opportunities among the set of companies that are available in India? And knowing that there are 5,000 plus companies in India, let's say 1,500 companies is my set of companies that I will look at, I think there are plenty of opportunities.
I think very true. I think in some ways, the way I understood what you were explaining, that of course you're positive about macro, you are seeing India with a lot of positivity over next 10, 20 years, but you're still investing in stocks, not not generally on markets, and that's something which is not a valid comparison. But again, we move on. There's a question from Prajal Jain, and I think the question has answer in itself. Like the question is, does lower allocation of Indian household somewhere reflect a bias towards gold and real estate when compared to peers? And what will be the metric that is best to decipher this allocation? Because you said from 2.2% to around 5.7, 5.8% in about 10, 12 years. And that's a good enough momentum for helping equities do well, and the market has done. So any comment on that, Rajeev? You want to comment on that?
Yeah, no, so I think absolutely we need to be careful when there's a lot of momentum in the market, right? And that is where 2024 was, which is why I do think this correction is helpful, because people can now assess whether they have the risk appetite to be able to stomach these type of corrections, right? And I always tell people corrections are good both in terms of your mindset, but also in terms of seeing what companies you are investing in, right? Now, in terms of the allocation, if you look at Indian households and where they can allocate, right, gold has done well. And of course, everybody will now run after gold. But the fact of the matter is that over time, if you see over 20, 30, 40 years, you have to look at and say which asset class does the best, right? And you should not just allocate to one asset class. That's the other thing, right? So you can say, well, I will put some in equities, I will put some in real estate, I will put some in gold. And if you find other high performing asset classes, you should put there. But the point is, you should put based on your understanding. So just like we need to have a circle of competence and invest in certain companies, similar is the case with the asset classes. If I don't understand real estate and I get into it, guess what? I am the one who will suffer the most because I don't know anything about it, right? But somebody who is that is something they are very comfortable in, they should do more of real estate. Or if on the gold side, I will say gold is something has done well, and typically gold does very well when we have surprises, or you have trade wars and stuff like that, and that is what we are seeing, which is not at all surprising. But gold has kept its value, and so there is some amount of allocation one can have to gold. How much depends on your own interest and your understanding of the situation.
Thanks, Rajiv. I think that's a very valid point, because a lot of times regret is directly proportionate to when you don't know what you are doing and do it on somebody else's advice. It's still better to make mistakes, but with your own understanding and with your own knowledge. So I think that's very fair. You should know what you are doing, and things will ultimately be fine. I think that's best we can hope for. There's a question on I probably somebody's trying to put in a spot, and I'll support that. That what do you think about the market over the next few months? There is some correction in Indian markets, 13, 14%. Of course, given that you don't invest for few months or few quarters, but still, if somebody has to take your view on what is the outlook for the markets in next 4 months, 6 months, or maybe 3 months, what do you have to say on that? How do you respond to that?
So I would say in the short term, it's very hard to predict what will happen. And it is much more going to be driven by what happens in terms of the economic activity out there, right? If, for example, Trump puts tariffs on India, and that impacts Indian industry, that could be very negative, as an example, right? And on the other hand, if he doesn't do that, it could be positive, because right now there is some negativity built in, right? So in the short term, I feel a lot of the market's performance is driven by the factors that happen. And it's, again, very hard to predict, right? And so therefore, I try not to predict short-term market moves, because there is no way. I know myself enough to know that I cannot predict it. And so for me to then give an answer to somebody which will not be the right thing, because I don't know, right? So I should accept and say I don't know is the real answer.
Thank you, Rajiv. I think that's very fair. And I think we are almost close to our scheduled time finish, but there are two very important questions which I would say a lot of people from the audience will be interested in. One is how concerned you are about falling INR, because this will impact the returns which people will generate in USD. And the second question is that how do you think higher volatility will lead to higher expected return? Because I thought that you are talking about volatility will create more opportunities and better opportunities. But these two questions, if you can take up, that will be great, and we'll close after that.
Right. So from a volatility perspective, Pankaj, I think volatility is definitely an opportunity, but it is an opportunity only if you can keep your psychology, your behavior aligned. Guess what? The biggest emotion that all of us have is fear. When is fear highest? When the markets are falling. So when our literature says that volatility is a risk, there is a reason for it. And the reason is that we don't behave rationally when there is volatility or when we are afraid. And so I think the important point is to actually just turn around that situation. And that is at least what we try to do, which is to say, listen, you bought a stock at 100, right? Going back to my example, you thought it was worth 150, you bought it at 100. Now it has fallen to 50. I'm going to take it more extreme, 50% drawdown. Now, if you still believe that it is worth 150, or let's say 125, it has come down some in terms of your assessment, guess which one is a better stock now? The 100 to 150 or 50 to 125? And so my point is, if you can reverse your psychology, and rather than focusing on what has happened to the price, you focus on what is the expected return, or focus on what you expect to do over time with that particular stock, given the current price, I think your mindset completely changes, right? And so keeping and understanding the company, and that is why the circle of competence is such a critical element. If you understand the company, then you will not be shaken up. And even though I'm coming here and saying, listen, you should not be shaken up and you take volatility as an advantage, the fact is, if I don't understand the company as well, I myself am shaken up. So that is why the circle of competence and the ability to understand the business is so critical. Because if you don't understand it, market will shake you out. And I have seen it enough with myself to know that I need to understand. And that is why this Buffett's concept of circle of competence is such a critical thing that we should all focus on.
And how about falling INR? Do you think that is going to be
the falling INR, I think traditionally, if you look at historically, we have seen that INR has fallen 3 to 4% on an annual basis, right? And so what you have to say is, can I, in INR terms, generate enough returns that I can offset the dollar appreciation that will happen or the INR depreciation that will happen, right? And my opinion is that we have demonstrated to ourselves, both in the fund, but prior to that, in my own personal capacity, that we can do far better in the INR terms, that we can offset it. But at the same time, the other thing which I did not mention is, I believe, as I showed the chart where the dollar index is at a high, you saw how the fiscal situation in the US is not as good compared to what it was. I am of the opinion that maybe the dollar appreciation of 3 to 4% every year versus INR may start to slow down, may not slow down this year or next year. But if I start to look over the next 5-10 years, I would not be surprised if that depreciation of INR slows down and is not as high as it has been in the historical sense.
Thank you, Rajeev. We have a lot of questions. I would say that, in fact, there are so many people who have sent us questions. Parth Somani, Vicky Prajapati, Kaustav Chaudhary, Jay Kadam. There are so many anonymous attendees who have sent these questions, but also Rohan Ramchandra Desai, Kaustav Chaudhary again, Sankalp Kumar, Mohit Verma, Madhav Sharma, Gaurav Surana, Anmol Narula, Syed Khizar Hussain Jaipuri, Rushabh Harshal Ravel, Lisa, Shimul Sen Gupta, Kamlesh Kumar, Mani Challa, again Sankalp Kumar, and Aditya Khemani and Mohit Verma. A lot of questions. My apologies, and I'm sincerely sorry that I can't take all these questions because we are already past our scheduled finish. But thank you all for sending us your questions, and thank you, Rajeev, for your insights, for your talk, for your presentation. And I said, your humility reflected when you said that the answer to that question, volatility, because when you said don't panic, actually it's very easy to figure out when somebody is telling you don't panic. From their tone itself, you can figure out whether somebody is panicking themselves or not. So I think that that's very true. And I think it reflects all the philosophies which you talked about, all the concepts you talked about, you practice and then you practice those yourself. And that's what reflects in your investment philosophy as well. Thank you so much for joining us. And it's a great session. I personally enjoyed it a lot. But to be honest, I hope that audience would have also found this very, very useful and engaging. Again, thank you, Rajeev, for sharing your perspective on such an important topic. This was extremely, extremely insightful for all of us. And as a reminder to our listeners, please do complete the evaluation survey that has appeared on your screen at the end of the session. CFA Institute and CFA Society India members may claim professional learning credit by logging in their online professional learning tracking tool. And this concludes our Practitioners Insight, investment opportunity in Indian equities with a global perspective. We are doing this with Rajeev Agrawal. Any final comments from Rajeev, you? Otherwise, we are done. And thank you once again, everyone.
Thank you for this forum, Pankaj. I think I really enjoyed this presentation. And one of the things I always tell is when I'm presenting and I'm teaching others, the one person who's learning the most is myself. So I am sure I benefited a lot as well.
Well said. And on this note, thank you, everyone. See you soon with our events on Global Practitioners Insights and our other events with CFA Society India. See you soon. Good day, everyone. Take care. Goodbye.